And there it is, the closing bell at the New York Stock Exchange. A strong close of the week for the U.S. stock market. The Dow Jones rose around 400 points.
The Nasdaq and S&P also ended the day in positive territory. Both climbed around 1.5%. Joining us now from the floor of the New York Stock Exchange is J.D. Durkin. He's the host of financial news websites TheStreet. Also joining us is Javier David. He's a CBS News contributor and the managing editor for business and markets for Axios. So, JD, let's start with you. The price consumption expenditures price index released earlier today showed inflation cooled last month. I'm just wondering, to what extent do you think this figure drove U.S. stocks today?
I think without a doubt, this is one of the significant things that investors were able to hang their hats on today. PCE, or personal consumption expenditures, this accounts for 2/3 of all domestic spending. And the go-to line for business reporters, as everyone in our world knows, this is the central bank's preferred gauge of inflation. So arguably, out of all of the metrics that Chairman Jay Powell of the central bank and his colleagues look at, it is this number. It still indicates inflation is moving up, but perhaps we have some evidence of deceleration, especially from where things went in January. Today is, of course, not just the final trading day of the week and the month. This is the final trading day of the quarter. And I think off of that optimism, we did have the Dow Jones, which had been down fractionally all day with representative to the last 3 months, eke out now a quarterly gain. The Dow year to date up 0.4%, the S&P up more than 7%, and the tech-heavy Nasdaq is up significantly 17% off of a lot of that optimism given today's PCE data.
And Javier, the PCE price index is the Federal Reserve's preferred measure of inflation. So how do you think it could impact their next decision on whether to have another round of hikes for interest rates?
Yeah, I think there's tentative signs for hope. We're all sort of, as for the last year or so, we've all been kind of hoping, wishing, and praying that the Fed will get the message that the market is sending, which is they absolutely are wanting or expecting easier policy. If you kind of believe the two-year note, which is signaling, well, the entire yield curve really is starting to show signs of a recession or bad things in the offing. The two-year note is yielding below the Fed's fund rate, which is a significant development and kind of shows that the message that they want to send to the Fed is that the easing cycle should at least be put on pause. We're just not entirely concerned that, not entirely of the opinion that the Fed is going to listen. So what the market wants is one thing, but what the Fed will actually do is quite another. But I think that judging by today's data, there's absolutely signs that consumers, are starting to get a little bit tired. And that's a good sign for inflation and a good sign, conversely, for the Fed to kind of pull back on hiking.
All right, JD, I want to circle back to you for a second and discuss jobs. All right, the number of Americans filing new unemployment claims rose only moderately last week. So I'm just wondering about the impact. How impactful is the robust labor market that we're seeing? How impactful is that to what's happening on Wall Street right now?
Well, perhaps this is indicative of a small step, and I underscore the word small step in the right direction if you're the central bank. Let's not forget, the expectation from Fed officials is that you need to take unemployment, which today is at 3.6%, and they see that number going up significantly higher. Some say as high as 4.5, if not 4.6% by the end of the year. And in terms of how that translates, there are different estimates as to how many Americans are expected to lose their jobs if we do see unemployment go up that high. Atlanta Fed calculators indicate that could be at least 540,000 Americans. And we heard that back and forth with Senator Elizabeth Warren and Chairman Powell on Capitol Hill a few weeks ago, where the senator from the Commonwealth says, Chairman Powell, you're talking about a potential number of 2 million Americans that may be out of work. So even though this weekly jobless claim figure was 198,000, it is more than Wall Street analysts had been expecting. And I know it sounds counterintuitive and scary, but we can't forget getting that unemployment figure a bit higher is actually one of the seemingly counterintuitive goals of the central bank in order to bring inflation back down to its goal of 2% and to be successful to try and cool off this economy just a bit more.
Javier, the Federal Reserve continues to look for signs the labor market is weakening. When do you think we can expect to see that?
We're going to get a pretty big sign next week, hopefully a couple of them, actually. We should be bracing for the monthly jobless jobs JOLTS data, which is just basically shows how many people are quitting their jobs or how many are resigning, and then the monthly payroll report. Those are going to be two pretty big avatars of whether or not the labor market weakening that we've all been expecting is finally here. Now, the slowdown in consumer spending is pointing in the direction of a softening labor market, because at the core of all of these inflation problems we have, it's been a high class problem to have, because quite frankly, what it means is people are still willing and able to spend. So there's been a moderation in wage growth. There's been a moderation, a deceleration really in what people are spending and how they're spending it. So that at some point will start to translate into a softer job market. But this is a job market, quite frankly, that still is pretty tight. Like we never really, one of the paradoxes of COVID was that a lot of people left the workforce and never came back for various reasons. And so there's still far more people like looking for, or actually far more people that are, want jobs or have jobs rather, I should say, than people that are in need to fill these open jobs.
One slice of the job market of particular interest to me, ABC News announced yesterday it is expecting to lay off around 50 of its employees, part of a decision from Disney to lay off 7,000 people over the next several months. So let's talk about media, JD. Your forecast for the rest of this year for big media companies like Disney, how tumultuous a year do you expect to see sort of across the board when it comes to media?
Well, sure. I mean, just to state the obvious here, I'm no economist, simply a journalist who looks at the data, much like Javier, as well as the deluge of headlines that we have about this. But we have talked about so much these tech layoffs, media layoffs, financial sector layoffs as well. Just in January and February alone, more than 121,000 employees in the tech sector. And this cut from Disney is 7,000 employees, like you said. That accounts for about 3% of the company's global workforce. And I think this actually underscores, specifically in the tech sector, why we've had the gains in the NASDAQ that we have. One of the unfortunate realities is whenever you talk layoffs, I argue the most important part of the story is the deeply human component. These are individuals, and they and their quality of lives for them and their families are significantly turned on its head here. But in terms of investor sentiment, investors will always gravitate and usually push a stock up whenever we see these cost-cutting measures. You look at names like Microsoft, Alphabet, Amazon, Zoom, Meta, and Intel. All 6 of those names have announced thousands of job cuts in the last 3 to 6 months. They're also all NASDAQ stocks, meaning they don't trade here on the floor of the New York Stock Exchange. They trade at the tech-heavy index up in Midtown Manhattan. I think that helps underscore why we have seen the NASDAQ year-to-date so far 17.6% up in the green, significantly outpacing either of the other major market indexes.
So Javier, on that note, I mean, it's not just media markets, right? It's not just media companies. We're seeing these massive layoffs across industries. But how do you reconcile that with such a strong labor market that you were just talking about?
Yeah, I think it's really important to keep in mind that what we're seeing in terms of layoffs are actually concentrated in a small slice of the economy. We're seeing media and tech. Both of these were areas of the economy that really sort of staffed up heavily during the pandemic. Some of this is kind of a give back. And in the case of like Disney, Amazon, Meta, Microsoft, some of these companies that have announced the bulk of these layoffs, their workforces, it's as a sort of it's basically a fraction of their workforce. So they have very large workforces. Amazon alone has, over 1 million workers. So the fact that they may be laying off 10,000 or 20,000 in the grand scheme of things, it's not that big. And some of these people are actually managing to find, because again, we have a very tight labor force, jobs in other sectors, in old parts of the economy, like automobile companies are hiring and food companies are hiring, and they need tech-savvy workers. And in the case of media, people that know how to write and communicate well. So there's a plethora of jobs still out there for people that are getting released from their job, unfortunately, that are getting turned out of their current roles.
All right, Javier David and JD Durkin, thank you all for making it all make sense.